Dre Parker here, and I want to go over part 2 of the power of leverage. So there's 3 places that people normally put their money, and that's the banks, that's your broker dealers for your investments, and that's your investment grade life insurance companies. Let's talk about the bank really quick. The bank actually is a great place to keep your money safe, but there's no growth. It's actually fixed. So your interest rates are really low. Your money is safe, but it doesn't grow. And it doesn't have creditor protection. You can get sued, garnished, levied. Your money can be taken from you. And it's taxed. So you have capital gains tax for whatever gains you actually get on the money if it does grow. So your money is taxed. You're at risk of relying on the stability of the bank. Now, here's the question. In the last 10 to 20 years, how many banks went under? That's a question I want you to ask yourself. How many banks went under? So let's talk about the broker dealer, right? Your broker dealer, you have growth opportunity, but there's no safety, and that's variable growth. Another thing about the broker dealer is it doesn't have creditor protection. So if someone decides to go after you and sue you, they can get your money. Now, there are some differences when it comes to your retirement plans because they are protected to some degree through ERISA because the plan sponsor actually owns those assets until you start taking your distributions. Then it's free game. So it doesn't have creditor protection. It's taxed, and of course, there's certain exceptions to those rules if you have municipal bonds set up through the broker-dealer or a Roth IRA set up through broker-dealers. But you got to remember, there are limitations there, especially on the growth of municipal bonds, and the Roth IRA has restrictions as well that you need to be aware of if you want to put in a lot of money. And of course, you still have the volatility of the market. So you're at risk of your investments going under. So let's talk about investment grade insurance. You have growth with principal protection, which is really important. Over there at the banks, you have safety, no growth. Over here, you have growth with principal protection, and you also have creditor protection. So you don't have to worry about getting sued. You also have tax-free income over here in this vehicle. This is why the ultra wealthy like to put their money over here because they worry about getting sued personally and professionally. And this is a vehicle where people have that type of protection. And another thing is there's no 59.5 rule like you do with the Roth IRA. And you're relying on the stability of the insurance company. And I'm going to go into how these 3 entities are governed next. So how they're governed is the banks. Let's talk about the banks. The banks need to have at least 1/3 of your money, and the other 2/3 they can actually invest. And of course, it's protected by the FDIC, which is the Federal Deposit Insurance Corporation. So that means that it's protected up to $250,000 if the banks decide to go under. Now, you have to know this. If the banks do go under, another bank has an option to buy them out. If not, the FDIC, they're going to take over. And let's talk about the broker dealer. So the broker dealer, they put your money directly into the investments. They don't really have to have money on hand like the banks and, as you'll see, the insurance companies. However, if you're going to invest and utilize a broker dealer, I highly recommend you use a broker dealer that is financially stable and top A rated. And if the broker dealer financially folds, well, you have this thing called SIPC, which is Security Investors Protections Corp, and they protect your investments up to $500,000. And let's talk about investment grade life insurance companies. Now, these insurance companies need to have 3 times their money in a Federal Reserve account before they can even invest your money. Now, that's huge right there. 3 times the amount of their money in a Federal Reserve account. You're probably asking why. Why? Because you have to realize that they have to still pay out claims, and they have to make sure that they have enough for operations, and they're making sure that they're still going to be financially stable. So this is why they have more stringent requirements when it comes to having money in reserves. And an insurance company, they need to have reinsurance, which is really important. So reinsurance is, hey, if I decide to close my doors as an insurance company, I need at least 3 other companies that agree to take over the contracts in case we decide to call it quits and want to go out of business. And for some reason, if an insurance company does become insolvent, well, reinsurance is going to take over those contracts, which is a good thing. So I have a question for you. If you can use some of your money in a small quantity and use someone else's money in larger quantities to build wealth, would that interest you? Let's say you put in 100,000 of your own money to start building wealth. Well, with the power of leverage, you're using other people's money or OPM strategy, and they're putting in the bulk or the quantity of the money to help you build wealth. And let's say you put 100,000 in and they put 1 million in. Imagine how much wealth you can build using this leverage strategy. So let me break it down just a little bit more. The bank's secret sauce. Many of you may be aware of it, many of you may not. The bank's secret sauce is when you deposit that 100,000 in the bank, well, guess what happens? The bank may pay you 0.01% interest. Now, that's nothing. That's no money. But what if they're generous and they pay you 1% out of the $100,000 that you just deposited? Well, let's take a look. They take your money and they lend it out. So your 100,000 deposit is being lent out to other people. And remember, the banks are responsible for mortgages, auto loans, and credit cards. Now, mortgages are on the lower end of the interest rate spectrum. Auto loans are somewhere in the middle, and credit cards, of course, they're high. You're talking about 17, 19% average when it comes to credit cards. So let's just say the bank loaned your money just for the sake of car loans or auto loans at 5%. Now, I know I want you to pay attention to the process because interest rates are always changing, but let's just say they're doing it at a 5%. They pay you 1% and they're loaning out this money just for auto loans at 5%. They just made 4%, $4,000 off of your money that you just deposited, and they paid you 1%. But let's go a little bit deeper. This is phase 2, which a lot of people may not be aware of. Phase 2 of the bank's secret sauce. See, at the end of the day, at 4:30, the banks, they have to report to the Federal Reserves how much they actually collected in deposits. You're probably asking, well, why do they have to do that? Well, there's 2 reasons. If they don't have a certain percentage of what they have out invested, they're going to have to close their doors. And they don't want to do that. And another reason is if they do have it, then they have an agreement with the feds to give them 9 times of what they have in deposits in a private loan. So you just deposited $100,000 of your money. And the feds say, hey, I'm going to let you borrow up to 9 times that amount. So the feds give them $900,000 of borrowing capacity at whatever the Fed fund rate is at the time. That's going to change but throughout time, obviously. But let's just say it's 1%. The banks are borrowing money at 1%. And you already know, look at this. Your $100,000 gives the banks borrowed capacity of $900,000 from the Fed. And let's just hypothetically say they're only taking that money to give out for auto loans at 5%. Well, guess what? The banks just made $36,000 off of that borrowed money of $900,000 plus $4,000. Let's say you wanted an auto loan as well, plus $4,000 of your money. The power of leverage is very important for you to get because they're getting the spread. But what if there's a way that you can get the spread? Because that's what it's all about. What if I said, I'll let you borrow money at 3% and you can put it somewhere where you can make on average 8% over a period of time? How much money would you borrow? If your answer is all of it, you're thinking on a level of building wealth. That's right, because it's all about arbitrage. That 5% net return is known as arbitrage. Now, I want you to stay tuned. I wanted to make this pretty short. I want you to stay tuned for part 3 of the power of leverage so you can see exactly how this could actually work for you, and it'll be more detailed.